Welcome back to the deep dive. Today we're digging into Uniti Group, that's ticker Unite. We're looking at their Q3 2025 earnings call.
Yeah, and this one was pretty significant. It's really our first proper look at the company after that huge Windstream merger closed.
Right, which means there's a lot of, let's say, accounting complexity. We need to figure out what's real performance versus just, one-time stuff from the deal.
Exactly. Our job here is to cut through that noise. The call happened pre-market, November 4th. And the core story they're pushing is this big transition.
Transition how?
Moving away from, the old structure
Yeah.
towards being this focused fiber-first company. They're really talking up the push to grab demand from hyperscalers and AI.
Okay, but let's pause there because the initial numbers seem kind of contradictory, don't they? I mean, they reported almost $5 in earnings per share. Huge number.
Astronomical, yeah.
But the stock actually went down a couple of percent after the call. So investors clearly weren't just looking at that headline EPS.
Not at all. That huge discrepancy, like you said, that's the whole puzzle here. It tells you the market is looking past the gap figures and thinking hard about execution.
So let's lay out those top line numbers first, just to set the scene.
Okay, so GAAP EPS, as you said, $4.92. Revenue came in at $722.6 million.
And adjusted EBITDA.
$327.8 million, which gives them roughly a 45% margin.
Right.
Pretty healthy on the surface.
But you're saying that $4.92 EPS is misleading.
Oh, completely. It's a total red herring. Almost all of that profit, about $1.685 billion of it, was a one-time gain purely from the merger accounting when it closed.
Ah, okay. So strip that away. What do the operations actually look like?
That's where things get more interesting. Operationally, the numbers were, pretty strong. Consolidated fiber revenue is up to 13% compared to last year.
And the consumer side? Kinetic.
Even better. Kinetic consumer fiber revenue jumped 26% year over year. That's significant growth.
Okay, 26% sounds good. But how much does that really move the needle when you've still got the drag from their older services like TDM and DSL?
That's the tension, exactly. But on customer growth for Kinetic Fiber, they added 36,000 gross subscribers.
Gross adds, right. What about net?
Net adds were 24,000 new subs in the quarter.
And how does that stack up? Is 24K good?
It's actually quite good for them. It's the second highest net add number they've posted in 2 years. So it shows the fiber product is resonating, it is gaining traction.
But the market reaction suggests investors are thinking, okay, nice quarter, but what about the bigger picture? This whole premier insurgent fiber provider strategy management keeps talking about.
Right. They're less focused on the accounting cleanup now and more on can these guys actually execute on this massive fiber build-out and transition.
Let's unpack that term insurgent fiber provider. Why insurgent? What's that supposed to mean strategically?
Well, I think it signals they're trying to be disruptive, not acting like a slow legacy telco. They're targeting markets, maybe tier 2, tier 3 cities, areas that giant incumbents might overlook or underserve.
And moving fast.
And moving fast. Trying to build scale and steal share quickly. That's the insurgent idea.
Okay, and speed depends entirely on building the network. So how did they do on the actual construction front in Q3?
They passed another 56,000 homes with fiber in the quarter. That brings their total footprint to about 1.8 million homes passed.
And are people signing up? What's the penetration?
Penetration reached nearly 29% across that footprint, which is up about 130 basis points from last year. So steady progress.
Now, to keep that pace up or even accelerate it, they talked about construction crews, right?
Yeah, this is a key point. They admitted they need to speed up. So they're shifting from doing most construction in-house to using a lot more third-party contractors.
How many more?
It's a huge ramp up. They plan to go from about 115 external crews now to nearly 400 by Q2 of next year.
Whoa, okay. 115 to 400 in what, 6 or 7 months? That sounds incredibly ambitious. Did they talk about the risks, quality control, cost overruns?
They acknowledged it's aggressive, yeah. But they framed it as necessary to hit their targets and meet demand. They did give cost guidance, though.
What are they projecting per home passed?
The forward cost, so for the new builds, is expected to be in the $850 to $950 range per passing.
Which is a bit higher than...
A bit higher than their overall blended average, yeah. But they see it as a necessary cost to get the speed they need. Interestingly, they did slightly reduce the homes passed target for this year, for 2025.
Oh, why?
Sounds like the ramp-up is taking a bit longer to get going, but they expect to make up for it and get back on track fully in 2026.
Okay, so they're spending big to pass the homes, but then you have to actually sign people up and keep them. They mentioned churn, right? Fiber churn being a bit high.
They did, yeah. They were pretty upfront that churn is higher than they'd like, higher than industry benchmarks, and they're mainly losing customers to cable.
So what's the plan? How do they fix that?
It sounded like a two-pronged approach. First, some operational hygiene, as they called it.
Hygiene, like cleaning things up.
Exactly. Things like writing off customers who aren't paying sooner, getting them off the books, and importantly, exiting the Affordable Connectivity Program, the ACP credit subsidy.
Okay, exiting ACP. Why is that significant? Seems like it would hurt subscriber numbers initially.
It will. They guided to about a 16 basis point hit to churn in Q4 just from that. But the thinking is, ACP customers, while important for bridging the digital divide, tend to have lower ARPU average revenue per user and higher churn rates historically.
So pulling out might temporarily increase churn, but it improves the overall quality and profitability of the subscriber base longer term.
That seems to be the bet, a short-term pain for long-term gain kind of move.
But why wait until Q3 post-merger to do this hygiene? If non-pay was an issue, why not tackle it sooner?
That's a fair question. Management sort of pointed to the merger complexity, getting new systems in place. But yeah, it does raise questions about maybe optimization being delayed a bit.
Okay, so that's the cleanup. What's the second part of the churn strategy?
Driving value. Fiber ARPU, that average revenue was up 10% year over year. So they're getting more per customer.
How? Price hikes or upselling?
Mostly upselling, it sounds like. Pushing customers to faster speed tiers. They said something like 65% of their fiber customers are still on plans under 1 gigabit per second.
Wow, okay, so huge room to move people up.
Huge room, using a more for more pricing idea. Get faster speed, pay a bit more. Plus, bundling value-added services to make the connection stickier, reduce the incentive to switch.
And they also flagged a new focus area, MDUs. Multiple dwelling units.
Yeah, apartment buildings, condos, that sort of thing. Apparently, this was kind of overlooked within the Kinetic footprint before.
Why is that important now?
Because MDUs are fiber gold mines, potentially. You wire up one building, and you have the chance to acquire many customers very efficiently. Much lower cost per acquisition than single-family homes.
So low-hanging fruit they hadn't really picked before.
Seems that way. New leadership seems to see it as a quick way to boost subscriber density without massive new construction costs.
All right, let's shift gears. The other side of the business, the wholesale fiber engine. This was the big rationale for the merger, right? And where management's talking about generational opportunities.
Absolutely. This is all about the hyperscalers, cloud providers, big tech, and the AI boom.
What evidence did they give?
They mentioned record bookings, MRR, monthly recurring revenue, said the hyperscaler sales funnel is now about 30% of their total MRR pipeline. And even more if you look at total contract value, TCV.
Okay, decent chunk. But what really stood out?
This was pretty striking. They revised their estimate for the total addressable market, the TAM, for AI and hyperscaler fiber needs.
They increased it.
They said they now believe the TAM is 50% higher than what they thought just at the start of 2025.
50% higher in less than a year. That's massive. Suggests demand is just exploding way faster than anyone thought.
Exactly. It implies the supply of suitable fiber just can't keep up with this AI-driven demand. It's a very, very bullish data point if they can capture it.
Did they give any specifics on deals?
They said deals expected in the next few quarters are likely to be the largest they've ever seen. And that gives them visibility into a strong deal flow for the next 3 years or so. They also mentioned blended cash yields on these deals are hitting around 34%.
They also brought up wavelengths, or waves. Said they have tiny market share now, less than 5%, but see big potential. Can you break down what waves are quickly?
Sure. Think of a dark fiber strand like a private highway. Waves are like leasing dedicated high-speed lanes on that highway. A hyperscaler gets guaranteed bandwidth without having to light up and manage the whole fiber strand themselves.
So it's a different way to sell capacity on the same network.
Right. And Uniti thinks, post-merger, they can compete effectively here. Not necessarily on price, but by offering unique routes, diversity, reaching those Tier 2 and Tier 3 locations where AI processing might be happening.
Okay, massive opportunity, aggressive build plan, but this all costs money. And they took on debt with the merger. Let's talk capital structure, leverage.
Definitely a key piece. It's a high-leverage business model, especially during a big investment cycle like this. They've been active managing it.
What recent moves?
They closed a new $1.4 billion notes package at 7.50%. and a new $1.0 billion 7-year term loan, refinancing, extending maturities.
Well, where does that put their leverage ratio now? Pro forma with Windstream.
Pro forma combined net leverage is sitting at 5.55x, They said they're targeting being in the 5.5x to 6x range by the end of the year.
5.5x, it's still pretty high, isn't it? Only really comfortable if that growth story plays out exactly as planned.
Absolutely. That 2027 inflection point they talk about becomes crucial. If execution slips or the legacy drag lasts longer, that debt load is the biggest risk to the whole story. The market sees that clearly.
How else are they planning to fund the kinetic build besides more debt?
They're very bullish on using asset-backed securitization or ABS financing, using the fiber assets themselves as collateral.
Like securitizing the future revenue streams from those fiber connections.
Essentially, yes. They estimate they have maybe $3 billion to $4 billion of ABS capacity just within the kinetic assets. And ABS debt is typically cheaper than other forms, so it helps manage financing costs for the build-out.
So pulling it all together, merger done, fiber growing, AI demand booming.
Wow.
When do we actually see the consolidated company results, the total P&L, start showing positive growth?
Management was pretty direct about this. Don't expect consolidated total company revenue and adjusted EBITDA growth until 2027.
Not until 2027, wow.
Yeah. They project the headwinds from the declining legacy stuff, the TDM and DSL, will basically cancel out the fiber growth on the consolidated level until sometime in 2026. That's when fiber revenue is supposed to finally become bigger than legacy revenue.
So it really is a long game investors need to play here.
Unequivocally, patience required. Which brings us, I think, to our final segment.
Indeed. Time for This Is Not Financial Advice.
All right, so we've got this fascinating setup. Uniti Group. Generational AI demand tailwind, they say.
Yep.
Strong fiber growth operationally. Record bookings potential.
But a highly levered balance sheet, complex integration still ongoing, and we just heard no real consolidated growth until 2027. And the stock dipped post-earnings despite a massive paper profit. Perfect conflicting signals.
Exactly. So the trade idea has to navigate that tension. It needs to capitalize on the market's understandable skepticism now, while still positioning for that potential huge upside if the AI pipeline really delivers down the road.
Trying to isolate that future fiber value from the current mess.
That's the goal, a synthetic position, basically.
Okay, lay it out for us. Remember, folks, this is not financial advice, just a plausible, if maybe outrageous, idea.
The pitch is focused squarely on that 2027 inflection point. So you'd go long call options, but way out in time. Elite long-term equity anticipation securities expiring sometime in 2027.
Betting on the fiber story eventually winning out by then.
Right. But ELEAFs are expensive. So to help fund that long bet, you'd simultaneously write or sell shorter-term call options against it, maybe out of the money calls expiring around Q2 2026.
Okay, so selling calls expiring mid-2026 helps pay for the calls you bought expiring in 2027. What's the logic behind that timing?
The bet is that the market stays skeptical and the stock remains somewhat range-bound until we get past that point in mid to late 2026 when fiber is supposed to become the majority of revenue.
So you collect premium from the short calls while waiting for the potential 2027 liftoff.
Precisely. The structure lowers your cost basis for the long-term bet. You're wagering that the real re-rating happens closer to 2027 once the legacy drag is less significant in the consolidated numbers.
But hold on, what's the risk there? Selling those 2026 calls caps your upside if something happens sooner, right? Like if a massive hyperscaler deal gets announced early next year and the stock spikes.
It absolutely caps the immediate upside from that specific spike. That's the trade-off. You're sacrificing some potential near-term gain to reduce the cost and therefore the risk of the long-term 2027 bet.
So it's a bet on delayed gratification.
You put it that way. Given management themselves are saying consolidated growth isn't coming until 2027, the odds favor the market staying somewhat cautious until that fiber majority crossover point is clearly visible in late 2026. It's calculated.
Okay, so wrapping this up. Uniti Group presents these two competing narratives, almost. On one hand, you have this incredible demand signal, AI, hyperscalers, record bookings, that stunning 50% TAM increase.
Huge potential energy.
But on the other hand, you have the execution reality. Integrating a massive merger, high debt, managing churn, and this multi-year wait for the overall financials to really reflect the fiber growth.
Yeah, it's messy right now. So the final thought we want to leave you with to chew on.
Go for it.
Management seems incredibly confident, boosting that AI TAM estimate by 50%. They claim 3 years of visibility into huge hyperscaler deals. The question is the market's current skepticism reflected in the stock price correctly pricing in the execution risk? Is it fundamentally underpricing the sheer scale of that future AI-driven demand tailwind if they do manage to execute?
something to think about. We definitely encourage you to keep an eye on that integration progress and, crucially, whether that massive wholesale funnel starts converting into signed deals. As always, this deep dive is for informational purposes only. Thanks for tuning in.